Let's bring in Michael Arone, who's back with us. He's Chief Investment Strategist at State Street Global Advisors on the phone. So, Michael, we've got a Jay Powell who says the economic picture is a glass that's a little bit more than half full. And I love the first line of your report because it says basically if investors want to be thankful for one thing, it's the absence of inflation this Thanksgiving.
Yeah, I think that with markets at all-time highs, investors have a lot to be thankful for, especially the fact that both economic growth and corporate profits have been decelerating all year long. And despite that, markets continue to hit all-time highs. Three things I point out in a recent report that they should be thankful for is the Fed has certainly done its part to keep this party going in the economic expansion, and Powell and his teammates have pledged to continue to keep that ball moving. Low inflation, as you mentioned, has been a key to keeping the expansion going. And the reason why it's important is one of the reasons why economic expansions end is because of tighter monetary policy. And the mechanism that usually gets central bankers raising rates is higher rates of inflation. And the fact that we can't get there has been a benefit for investors. And lastly, the U.S. consumer, and we're going to get data here in just under an hour that's going to signal to us that the U.S. consumer continues to be in very good shape.
The last consumer sentiment on Friday suggests that. Consumer confidence, as you point out here at 10 a.m. Eastern Time, 9 in Chicago, will be the update. So, Michael, then where are the risks in the market? There's always that kind of lingering question of, burying inflation in the grave right before it turns around, but that hasn't been a problem. So what is the potential holdback?
I think the biggest risk, and you can see the markets just the high sensitivity to news headlines around U.S.-China trade negotiations is amazing. So 3 times we've been 90% near a trade deal, and each time as we kind of approach that goal line, I guess with Thanksgiving football, it's a theme we're going to continue to go with here, is that we just can't kind of punch it into the end zone. And I think we're moving from a market that's about tell me something good about trade to show me something good about trade. And I know in your previous discussion you were saying that, 10-year Treasury yields and the bond market just isn't buying all the good news on the economy. And I really do believe it's the uncertainty about a U.S.-China trade deal, when it's going to happen, what it's going to look like, and what it's going to mean has really been the headwind, if you will, for us getting even further stock gains here.
So that brings me to, I think it's a point that we've discussed before, Michael, but it continues to be worth a mention as far as I see, which is the risk that there's still offsides positioning by investors for a breakdown either in trade, the economy, or something, because once again, we've got yield curve flattening happening this past month despite VIX going sub 12, gold coming off with some pretty decent speed from its own highs. Everything basically now, even crude oil starting to show some strength, suggesting things aren't as bad as we think. So what's the deal with the bond market? I mean, how many times are we going to have this curve flattening before we start to consider maybe we don't believe the economic signals of the U.S. Treasuries?
Well, I think what's interesting is the Fed has done a very good job in terms of it's had 3 rate cuts. It's pledged to buy Treasury bills all the way to the middle of next year. It's operating the repo market to provide support there. That's put downward pressure on short rates. And as the worst fears of recession have receded since August, you did see some steepening. But Ollie, here's the deal. We're still in a low growth, low rate, low inflationary environment, and the Fed and other central banks and even fiscal policy have not been able to change that trajectory, and the bond market's just not buying it until they see some more proof that we're going to see a reacceleration in economic growth or inflation. And I would have to say, even though the economic data isn't as bad as we thought, it's certainly not hitting on all cylinders. It's certainly not signaling an economy that's too hot by any measure.
Right. And I think that's important, right, is that there still is a baseline level that is a little bit slow. That being said, a lot of times, Michael, when I talk with investors who are have a lot of duration exposure in their long treasuries and their long utilities and their long, and basically anything that's kind of levered to lower rates, it seems to be a assumption that the central bank put is sort of still in this market, but Jay Powell says no, it's not here. In Europe, they're talking about the need to pass over to fiscal stimulus. So is this not a bond market that is kind of hung up on this idea of central bank puts still when they're trying to extricate themselves from that entire situation?
Well, it's been a very long time. I think investors have learned for almost 40 years that central banks have supported the markets and will continue. I mean, you go back to Black Monday back in 1987, long-term capital, 9/11, TMT, the Great Recession. And Ollie, we don't have to look very far. The fourth quarter of last year, public listed markets are down 18%, and the Fed quickly stepped in to settle things down and to pivot from a tightening posture to an easing posture. I mean, how could we not think that there is a Powell put or a support from the central bank as an investor? It's been proven time and again, and I think it is something that will continue to support markets. It's going to be very difficult for investors, in my opinion, to get too defensively positioned or to raise too much cash at a time when both the government and the central bank, most notably the Fed, are supporting markets through any way that they can.
So, Mike, right now, does that mean that you want to be positioned in some of the cyclical names? Do you want to give some credence to the small cap and the financial-driven strength that we saw yesterday? Is that going to be something that continues? Or to your point about the economic data, do we need stabilization to turn into acceleration to some degree to justify what's been happening with some of those stocks?
I think you need to remain balanced as an investor. So I think in an environment where the Atlanta GDP Now figure suggests that fourth quarter economic growth on a year over year is going to be about 0.5%, you need to have sectors of the market who are their return on their invested capital is sizably above their cost of capital when the cost of capital is zero. That leads me to technology. It leads me to communication services with very high growth rates. Sure enough, those growth rates are coming down some, but they're fast-growing sectors of the market. I think you need to balance that some with out-of-favor cyclicals that still have some interesting tailwinds like healthcare and financials. So healthcare certainly has been unloved. It trails the markets by double digits. It's the second cheapest sector of the 11 economic sectors. It has some real strong structural tailwinds in terms of aging demographics and the R&D spending on healthcare. And I think it's got a little bit of a political overhang. So if you can withstand that, I think analysts have been increasing their expectations for earnings and revenues, and that showed up in what was a difficult third quarter for everyone else. Healthcare did well. So I think that is an interesting opportunity in a sector that isn't so cyclical.
Michael, given that we're talking about stabilization as opposed to real speed of growth in the economy, are markets looking exposed in equities now that they're trading at the most expensive trailing valuations since September? Is there going to be a need for the earnings outlook to turn around? Because if the economy is just flatlining instead of picking up, then why would we think that earnings would suddenly pick up? I mean, is this a market that's going to have to get cheaper through valuation correction?
I do worry that we're trying to thread the needle here. And what I mean by that is most of the stock market returns this year have been investors' willingness to pay a higher price today for future growth. And that future growth is based on two things: a U.S.-China trade deal and a much easier Fed. Now that the watered-down trade deal that we may or may not get at some point isn't likely to have as big an impact on corporate earnings as I think, and economic growth that many are expecting, combined with the Fed that's signaling they might be on hold for a while, I do think those earnings expectations have to come in some. I think they're overly optimistic. This doesn't mean the market will decline or enter a correction or anything worse, but what it does mean is that the pace of these gains is likely to moderate, and therefore we should be careful around our expectations next year, both for returns economic growth, and even corporate profits.
Mike, so last point then, because to connect this all together, to just take what you said there about the U.S. stock market seeming to be poised in expecting a trade deal, when we just talked about bonds, right? It seems like they're not expecting the trade deal. So if there is an arrival of something, then is there a situation that could arise where stocks are selling the news as we finally get what they've been pricing in, and then bonds have to reprice to acknowledge this progress? I mean, that's a situation where bonds drop and stocks drop.
Potentially. I mean, I think what will happen there is if bond rates were to increase, right, and meaning bond prices would decline, it's likely because bond investors will be pricing in a re-acceleration of growth or inflationary expectations, which to me would lead to this idea that we perhaps there's optimism around this U.S.-China trade agreement that it will in fact help economic growth and corporate profits.
Right, that's got to happen.
I think that will be a negative for stocks, Ollie. I mean, I think that they'll celebrate that as well, because you'll see an improvement in fundamentals from that standpoint.
Yeah, assuming that this trade deal is something good enough to invigorate growth, right? That's basically the crux of it.
Right, and I think what you're kind of picking up on, right, is the bond market isn't necessarily buying it from that standpoint, but stock investors have certainly bought into this idea that it's going to be a big help. And it goes back to that very question that you asked me just a few moments ago around what are the risks, right, if valuations are a little stretched, markets are all-time highs, lots of good news priced in. It does seem like markets are highly sensitive to headlines and outcomes on U.S.-China trade.
Right.
I think bonds are reflecting a little bit of skepticism, even if we get a deal, whether it will be enough, and stock markets are bought in on that this is going to re-accelerate growth and profits next year.
Okay, Michael, fantastic talk. Good as always. We kept you a little longer there into the bell because I think it's a really important conversation. Michael Arone, Chief Investment Strategist at State Street Global Advisors. Thanks, sir, as always.